With so many investing philosophies, trading approaches, and opinions of self-proclaimed market experts, it can be difficult to stay rational and know how to maximize your Bitcoin gains. So this is how to avoid FOMO and implement the best BTC strategy possible. Today, we're going to be looking at how you can implement the best Bitcoin strategy for you and definitely avoid FOMO, which is one of the worst things you can do as an investor. So I think before we go into this, we should set the foundations of how we're actually going to create a strategy. So I've made this before, I mentioned it a few times, the Bitcoin trajectory catalysts, or better known potentially by the acronym BTC, is made up of the most influential factors impacting the Bitcoin price appreciation or depreciation. So these are first and foremost macroeconomic data, BTC fundamentals, Onchain Data, as well as technicals. Aggregated and used as confluence, these are the four pillars of the Bitcoin price action. So if we go first and foremost to the macroeconomic data, like we started on here, this is the global M2 money supply versus Bitcoin year on year. And to build this strategy, to make sure there's not too much bias or influence, obviously I know the Bitcoin price history to some extent. I'm going to remove the Bitcoin price action because realistically, we can use metrics, charts, data, all like this. And really the Bitcoin price action doesn't matter too much because these are going to tell us everything we need to know. It's going to eliminate the noise, unnecessary signals, and it's just going to really simplify the process. So for this, all we need to do is look to make sure that this is 1 above 0. So this is global M2 year on year increasing and preferably increasing quite exponentially. If we know that this is increasing, then we know that Bitcoin is probably in quite a bullish market conditions just due to the fact that there's more and more fiat available. And if this is decreasing, then we know potentially Bitcoin's probably in a pullback. If we can see maybe central banks and governments around the world are maybe tightening up their economic policies a little bit, we're maybe seeing more traditional market drawdowns and recessions potentially. So we probably don't want to be buying at that point. We maybe want to wait until this is actually bottomed out. We definitely don't want to be selling at that point either, but maybe wait until we're beneath 0, potentially forming a little bit of a bottom for a more confirmed signal of a purchase. And especially if we look at that alongside the high yield credit cycles, this is not only taking into account the supply and demand of fiat currencies and more risk on products, but this is looking at the sentiment of traditional market investors. Once this is increased exponentially, definitely above 50%, we know that not only Bitcoin, but probably all markets are in a risk-on environment. Investors are trying to maximize their gains and returns and are looking to potentially buy things a little bit more speculative. This is, of course, focused on high-yield credit, which isn't the most speculative or risk-on asset. But if the sentiment is more geared towards these compared to more traditional US treasuries and bonds and more safe haven assets, then it's definitely a good thing for BTC. So for taking profit, we want this to be very high. For scaling in, we want this to be very low. And kind of in this middle ground, we don't want to do too much. For successful Bitcoin investing, you don't need to be very active. You can really take trades once every few years, scaling in and out, of course, but really for long periods of time, weeks, months, like we said, years at a time, you can just kind of sit and not do a whole lot, especially just looking at some more macro data points like these. And if we look at this alongside some on-chain Bitcoin data, the Puel multiple is looking at the yearly average of Bitcoin miner earnings compared to the current day. So we can see again very clearly the health of the Bitcoin network. If this is increasing, miners are pouring resources into the network and are being rewarded to do so, likely by higher Bitcoin prices, but this could also be fees as well. So really, if we can see this increasing, we know that Bitcoin is probably in a bit of a bull cycle, especially once this gets to this red sell area, we want to be taking profit a little bit, and vice versa. Once this is decreasing, probably want to step away from selling too much or buying too much. We want to wait for the most opportune moment, which is at these green buy areas down here. As well as this, we also have the 1-year Huddle wave, another on-chain metric. What we can do is wait to make sure that this is decreasing before we take any profits. Again, if this is decreasing, we know there's more market participants coming in, as well as the fact that people that have been holding Bitcoin for at least a year are now starting to take some profit on their positions. We probably want to be following these more experienced traders rather than the ones that are coming in and acting on FOMO when it comes to our investments. So for selling, we want this to be probably decreasing quite at a rapid rate. And for accumulating, we want this to be increasing at a rapid rate, potentially topping out. But again, there's a lot of time here where it's decreasing a little bit in these middle periods here. We don't want to be doing too much. We want to wait until we've had this decreasing for a long period of time or increasing for a long period of time, as market cycles do tend to take quite a little while when it comes to Bitcoin. Along with that, we have the Pi cycle top indicator for a more technical chart. We can see here the 111-day and 350-day moving average. Now, obviously, I know once these cross, this is the ultimate Bitcoin sell signal. But if we just ignore the cross and assume that in the next cycle, we will not get a Pi cycle top signal, which is when this orange line crosses above the green line, which is where these vertical lines are. If we just look at the fact that when this 111 days decreasing, the market is probably in a downtrend. And once it's increasing and beginning to converge with this 350-day, it's probably getting close to a market top as well. So like we said, we can see that this is increasing a little bit now. We have to assume that this signal isn't going to definitely signal the absolute Bitcoin peak in the next cycle. So if we just look to see when these are beginning to get closer and closer, both are trending very much to the upside, that's another great indication of a profit taking period. And the same is true for the downside. Once these are widening very substantially and they're both decreasing, we know it's a good time to potentially start scaling into positions. And finally, a very short-term technical metric, the active address sentiment indicator. This gives, again, clear buy and sell signals. Once this crosses above this upper red deviation, we definitely know that the market is getting very overheated. There's a huge amount of Bitcoin price increase that hasn't necessarily been backed up by a huge amount of new users entering the network. And same is true for the downside. If we see a huge decrease in price action, and that is kind of in divergence to the amount of active addresses we're seeing, it's a good area to potentially start scaling into positions. So I know this was a lot of metrics, but very quickly, just to go back over them, we want to take profit when this is rapidly increasing and coming to the top, and scaling when this is rapidly decreasing beneath zero and potentially coming to a bottom. Same for the high yield credit. Once this is increasing rapidly and is near 100%, there's a huge appetite for risk on assets. This is when we want to be taking profit, and we want to be scaling in when there's almost no appetite for risk on assets. We're not FOMOing, we're buying when there's blood in the streets. Same for Onchain Data. We want the market to be seemingly in despair. Everyone's capitulated, including miners. Earnings are down. Everything that can go wrong has gone wrong. That's the best period to buy. And when everything seems like it couldn't be better, it's probably not a bad time to sell up in these red areas. Same is true for the 1 year Huddle wave, another on-chain metric. Once this is coming down substantially, it indicates that new market participants are coming into markets. So this is not only a bit of a fundamental factor, but also an on-chain data point as well. And again, once this is increasing massively, probably when we're going to start scaling into positions because no new market participants are in, and people that have been in the market for a long period of time don't want to take any profits. They realize the opportunity cost of selling at those moments. So they're going to wait out, and this is when we want to start accumulating as well. And then the short-term technicals, market cycle charts as well give us great signals. And once we actually combine all of these, once we see when this is topping out, once we see when this is bottoming out, same for this, same for this, same for this, once more with this, and again with this, we actually see an amazing strategy where we start scaling out of the positions at the very peak of the market cycle. February, March, April 2021, January, December 2017, that's when we're taking profits based on all of these in confluence. Once all of these are giving the same signals, it's really a no-brainer. At that point, you really need to consider taking some profits, because once we get the confluence, when we get these aggregated signals, it increases the validity of every single one of them. And again, when we start scaling into the position around September, October, November, December 2022 potentially, well, it just turns out that was exactly when the market bottomed out, as indicated by every single one of the metrics we've discussed today. So really, the basis of this strategy is to just add everything together, go through a checklist, have a very systematic, non-emotional, non-biased approach to your investing. And ultimately, doing something like this, you're going to outperform a vast majority of other investors who are just basing their investments off what they see on social media, their own emotions, their own biases. And ultimately, that is almost impossible to sustainably see success with. Also, if you haven't already, please don't forget to like this video, subscribe to the channel, and turn on notifications to ensure you're receiving all of our content as soon as it's released. And make sure to check out all the resources we've discussed today, as well as the many more that are all available on lookintobitcoin.com, your number one source for Bitcoin information. So just to summarize, with each chart and metric in agreement, we can assume the subsequent signal we see is amplified in terms of its likelihood to come to fruition. Or in simpler terms, if everything is saying sell, it's probably not a bad time to sell. And this search for confluence should be at the core of your approach to both entering and exiting the market. Not only does this strategy simplify your investing and remove personal bias, but also removes false signals and improves profitability, especially as these signals aren't going to come too frequently. It allows you to maybe start saving up some capital to average in at the market bottoms and really take your time when it comes to planning out exiting your positions, rather than looking at the market every day, looking at 1,000 different metrics, taking into account so much news, fundamental things you see, all the things you see on social media. They're just clouding your judgment. This way is such a simple approach. And if you imagine yourself as simply executing a predetermined checklist, an emotionally detached investing robot, this is absolutely the best approach for your Bitcoin investing. But ultimately, I know this is hard to do. It's hard not to get carried away when we see prices increasing exponentially, decreasing massively. Obviously, that does affect our emotions and psychology when it comes to our investing. This is why for this, I think it's handy sometimes to just remove the Bitcoin price, to look at things from a macro perspective and not be clouded by the intra-week, intra-month, intra-day volatile swings that Bitcoin is known for. If we just take a step back, have a very simple, methodical approach to our investing, like we've discussed today, it's very much the foundations for a very successful strategy. If you like this video, then please visit lookintobitcoin.com, where you can also consider becoming a site subscriber to gain access to professional resolution charts, advanced macro and portfolio data tools, in-depth crypto industry reports, live and personalized indicator alerts, private trading view scripts, and more, all for a fraction of the standard industry price. And let me know what your thoughts are when it comes to your Bitcoin investing. Are you maybe focusing on your gut instinct and intuition a little bit more? Maybe you've fine-tuned that over years of experience and can actually outperform a vast majority just based on your own opinion and feeling. If that's so, then great. If not, are you using more of a methodical, logic-based approach like we've discussed here today? And hopefully that is leading to a lot of success. As I said, let me know both down below in the comments and on social media. I look forward to reading and replying to all of them. Thank you all very much for watching, and I'll see you in the next one.